Hey friends, in this video I'm going to talk about strategizing which retirement accounts you contribute to. So why have a strategy for this, or why contribute to retirement accounts at all? Well, this gives you the opportunity to leverage some of the tax benefits that come with these accounts. So I think a lot of people can relate to me whenever I say that after I got my first job out of college, and then I became eligible for the company's 401k program, of course I signed up and then I started just contributing what my employer would match, which was 3% of my salary. So I was putting 3% in and my employer was putting 3% in. But then I just stopped at that, and then any other income that I had coming in that I wasn't spending was just sitting in a bank account that was earning 0.001% interest. So as time goes on, I see my pay stubs and I see how much in taxes I'm paying over the year, and it's quite a bit. And then even come tax time, I end up owing, because on my W-4 I claim 2 because I don't want to give the government a tax-free loan. So you start seeing how much in taxes you pay, and you start thinking about, well, what can I do to kind of get my taxes down? So in the past couple of years, I've gotten serious about really strategizing, contributing more to my 401k, and opening up a couple other accounts. So this is not a one-size-fits-all strategy. This is more of a framework where I'm going to discuss some of the questions I had to ask myself in order to answer where I should be putting my money and at what time. And this is something that I've taken the past couple of years, that's a strategy that's evolved. So you should think of it the same way, where this is not something you're going to come up with and figure out overnight. It's a strategy that should be evolving, and it's okay if it's changing. So starting with the first account you should contribute to, if your employer offers a 401k program and they offer some sort of match, you should definitely first contribute to that. And I would say do the up to the employer match and then stop with the 401k. That's because the next account that I suggest is a health savings account, and you are eligible for a health savings account if you have a high deductible health insurance plan. And the reason I really like the HSAs is because of the triple tax benefit that you get. Your contributions are tax-free. You can invest your contributions once they post to your HSA account. You can then buy funds. Most health savings accounts will offer funds that you can buy, and these are no different than the funds you would buy through your 401k or through your IRA. And all of that growth you get, that's also tax-free. And then your distributions are not taxable as well, as long as you use them for medical expenses. And once you hit the retirement age, you can even use your contributions to pay for your Medicare premiums. And so if you are on a high deductible healthcare plan, but your employer doesn't offer a HSA plan, you can go out on your own and open one up yourself and contribute to that. And that kind of gives you a little bit of benefit, because you can do a little bit of shopping for HSA accounts that have a higher interest rate, although I think they're all fairly low. If your employer does offer the HSA and they are deducting those from your check every month, that money's also not subject to Medicare and Social Security. So that's another 7% you're saving off of those contributions. So I say work towards maxing out your HSA before you contribute to any other account. And the current limit as of 2019 is $3,500 for if you're filing singly on your taxes, or if you're filing jointly is $7,000. And the reason why I say to max this account out before any other account is because you should be thinking of the long term for your medical expenses. Once you retire, most likely your most expensive cost is going to be your medical expenses. But getting back to why you should max out this account is because those contributions, whenever they post to your HSA account, you can use those immediately. You can use those today for any medical expenses. So I use those whenever I go to get my teeth cleaned, or my eyes checked, or I buy contacts. And you can also reimburse yourself from your account. So say that you want to use your credit card, You don't want to use your HSA debit card. You want to use your credit card. Say you want to get those rewards points. You can actually pay for your medical expenses with your credit card, and then you can reimburse yourself. You just gotta submit some paperwork, but it's very easy. And most HSA providers will either send you a check or direct deposit back into your personal savings account. So once you've maxed out your HSA, then it's time to start looking at your 401k. Start looking at the fees for that. If your 401k has high fees for all of the funds they offer, you're going to want to just go with a individual retirement account instead of switching back to then contributing what you can to your 401k. If your 401k does offer low fee funds, then go ahead and switch back to that. And so that brings up the question of, well, how much in fees is too much? And that's going to be about 1%. If you can only get funds through your 401k that are 1% or above, consider an IRA, because think about it this way. You want about 8% return off of your contributions. And if they're taking 1%, that's a considerable amount over time. And so let's deviate to individual retirement accounts. So say that unfortunately your employer goes through a company that for their 401k that only has high fees. So we'll pause on contributing to the 401k. We're still contributing our employer match, but we're going to switch to our IRA. And an IRA is individual retirement account. And so think of it as a 401k, but it's not associated with your employer. And the benefit that comes with it is you get to do some shopping. A 401k, you're at the mercy of whoever your employer goes through to provide that account. Well, IRA, you can do shopping and research what are their fees. You can research what funds they offer and what's the performance of those funds. So go ahead and contribute to your IRA until you have that maxed out. And once you do, then go ahead and switch back to your 401k until you then have that maxed out. Or if you're in the situation of your 401k does offer funds that are low fees, go ahead and start with your 401k and max that out before you think about going to opening an IRA and contributing to that. So a decision you're going to have to make whenever you contribute to your 401k or IRA is, do you want to do a traditional account or do you want to do a Roth account? And the difference is, a traditional is pre-tax, where whenever you contribute those, that money is not taxable until you start making distributions off of it during your retirement years. A Roth, you're going to pay taxes on those contributions now, but later on in retirement, whenever you take distributions, you don't have to pay taxes on it then. And also all of that growth that you get off of it is not taxable because you've already paid your taxes. So I think one of the big questions to answer which one you should go with is, well, how do you want to live during retirement? Do you plan to be spending more in retirement than what you currently make? Or maybe it's opposite, where you plan to spend less in retirement than what you currently make. If you plan to spend less during retirement than what you currently make, you're probably going to want to go with a traditional, because you want to defer paying your taxes until you retire, because whenever you retire, you're probably going to be in a lower tax bracket. So it makes sense to defer paying taxes on those contributions until you're in a lower tax bracket. But say that you plan to spend more money during retirement, it would make sense to go ahead and pay your taxes now while you're in a lower tax bracket, because during retirement you might be in a higher tax bracket since your spending will be higher. Another thing to consider between a traditional and Roth account is, with a traditional, that all of your money is locked up until retirement, unless if you do take out any funds, you're going to pay a heavy penalty on it. Whereas with a Roth account, you can take the principal amount out at any time. Your principal amount is just your contributions, and then any growth that you get from your contributions, you can't touch that until retirement, but you can touch the principal amount. So that might be nice if you are worried about something coming up to where you do need those funds. Really ideally, you'd want to have an emergency fund available just in your regular savings account instead of having to touch those funds. Also with a traditional account, there are reasons you can withdraw, such as buying a home. You can actually take out a loan against those funds, but you just got to make sure you pay it back on time. Otherwise, there's some heavy penalties with that. And there are things you could speculate about, like, well, what are the tax rates going to be? What are the tax brackets going to look like whenever I do retire? That's entirely speculation. It's hard to say what those will look like. You could say, well, I'm going to pay my taxes now into a Roth account because I think taxes are just going to go up and up in the future. You could look at it that way, but there's no way to guarantee that that's what's going to happen. So I plan to spend less in retirement than what I currently make. So I contribute to traditional accounts for my 401k and IRA. But an important note about contributing to a traditional IRA and taking advantage of that tax benefit is that you can only leverage that benefit up until you have a modified adjusted gross income of $64,000 a year. So what does that mean? First, let's look at what your adjusted gross income is. And that's basically just your gross income minus things like contributing to a traditional 401k. Well, that brings your income down because that's not taxable at this point in time. So modified adjusted gross income is basically that you've contributed to an HSA, a traditional 401k. Well, that brings your income down. Modified adjusted gross income is some of those added back, and it's just like it's a short list of some of that added back to bring it back up. So that's the amount you need to worry about with this $64,000 limitation. After that, it is your tax benefit, the amount that you can deduct off of your tax filing your taxes. That starts to become prorated, and then up to I think around 70,000, you're just not eligible for that at all. So think about it this way: say that you don't contribute to a 401k or HSA, you just get your paychecks and that's it. You don't contribute to anything else. And say you make $75,000 a year, and you go and open up a traditional IRA, contribute to that, and you thinking that you're going to be able to take advantage of this tax benefit. Well, you actually can't because you make above the limit that's set on this account. But a way that you could get around that is by contributing to your HSA or your traditional 401k to get that dollar amount down. So you make $75,000 a year. The max modified adjusted gross income is $64,000. Well, contribute, what would that be? $11,000? Contribute $12,000 to your 401k, and then you can leverage this tax benefit on the IRA. So that's why it becomes important to know how you can strategize. So that's my strategy. I hope that this has gotten you critically thinking about your situation, and you can come up with a strategy and start setting some goals, and then this strategy will help you to achieve those goals